Hi everyone, welcome to session 5 of our course on digital currency and Web3. My name is Lambis and I will be your instructor for this session. We had an amazing session last week with Charles from Ledger. I hope everyone was there. I was fortunate enough to be moderating the discussion. And of course, I was joined by Professor Iachlis and Professor Curtis and Andreas. And I had a blast, to be honest with you. I hope everyone is looking forward to the Ledger devices that we're going to be giving away. This week, we're talking about decentralized finance. But before we start, again, I'm joined by Andreas. He will be helping out throughout the session, and we will be having discussions. With everything going on in the world, I want to again extend my best wishes also on behalf of other members of the team to every single one of you, especially to those of you affected by conflict. We have a large family in the Middle East and wider area. So I hope you're staying safe. I'm glad you could make today's session, and I want to thank you for submitting some amazing questions that we will be going over. Before I do that, I want to ask you to give your definition of decentralized finance in the chat now. What is your understanding of decentralized finance? And while you're doing this, I can see people joining us from all over the world. We have Jorge, George, I'm not sure how to pronounce this, from Brazil. We have Peter from Australia. We have Peter from Canada, from Quebec, Canada. We have Subfanarov from Cambodia. I mean, I always make an effort to try and pronounce names. I know I'm not the best. Obviously, no one can be the best, but yeah. We have people from Lebanon. We have people joining us from Brazil. Lots of people from Brazil. Again, Pelagio says, regarding my question, what's your definition for decentralized finance? Pelagio's definition is it's finance transactions without any central manager, without any central intermediary. And I'd say this is a very good definition. We have another student weighing in and saying DeFi is a system of financial services that runs on blockchains instead of banks. What an excellent definition. Thank you very much for that. What do you think, Andreas? What's your definition of decentralized finance while other students are weighing in the chat?
Well, thank you, Labis, and hello everyone to the session. I would say it's a combination of all these definitions that we see in the chat. It's pretty much an alternative financial system built on Web3. So it uses the power of blockchain and decentralization to create new use cases, innovative use cases, different ones for different financial aspects and processes, I would say.
A very diplomatic response.
But that's what it is, though.
Well done, Andreas. More people weighing in. DeFi is a financial system that doesn't have a central authority based in smart contracts instead of banks. Very good answer. Another answer uses smart contracts to provide financial services without centralized intermediaries. DeFi is different to CeFi, centralized finance, as it does not rely on the traditional financial system. Again, you're seeing some patterns emerge. My personal definition of DeFi echoes what you said. Decentralized finance is a spin on finance that replicates and extends on traditional financial applications that run on smart contracts deployed atop blockchains and do not rely on traditional intermediaries such as banks, payment service providers, other financial entities. Again, intermediaries are not entirely absent from DeFi. This is important to keep in mind, as we will see in today's session, but it does not rely on traditional intermediaries.
And I think the key word that you said here, Lambis, is extends, because we all realize that DeFi in itself is a very complex system, well, more complex than traditional finance in terms of how everything is settled. However, this complexity also comes with the added benefit of being able to create more interesting and maybe new use cases as well. Yeah, it's up for discussion for sure.
And there is an argument to be made that some of those DeFi innovations are results of regulatory arbitrage or are coming from DeFi operating in a regulatory gray area. And as regulation takes over and as those entities become more regulated, those will be reined in to some extent. But I think it is equally as likely that we're going to see traditional finance application considering things that we can now do in DeFi and incorporating them in more traditional markets. I'm thinking, for instance, about flash loans, which are an innovative type of loan that doesn't require collateral. I'm thinking about perpetual contracts that are a new kind of derivative. Again, I'm getting way ahead of myself. Thank you everyone for weighing in. I've asked Andreas to prepare some polls, which we will launch now. I want to hear your opinions on a few things. And then we go over some of the slides and some of your questions.
So let me just clarify that the second question is multiple choice. So you can choose any of the options. The third one is one choice. And yeah, after you all answer all three of the questions, we can go over the results and discuss and see what you come up with.
Perfect. Okay, so we all know. I'll be going over the slides once as you're answering. So we all know what traditional finance is. Why is DeFi needed? Because traditional finance has some drawbacks. It has financial exclusion. It comes with high costs and low speeds. It lacks transparency and poses systemic risks, and it is prone and susceptible to crisis and bank runs. You will also see a point here on the politicization of money. What this point wants to convey, I think, is that currently money in the world is controlled by states. And states and other entities under the umbrella of the state, such as central banks, make choices regarding this money that some people find unpopular. Right? One example of such choice is when interest rates are cut or risen. Another example is who has access to identities and under what terms, which also determines who has access to finance. So everything that touches money, in my view, including money itself, carries political weight. And there is no such thing as apolitical money. Bitcoin and other decentralized cryptocurrencies were not apolitical money. They were not advocating for money that was stripped of politics, but rather they were advocating for money that was not controlled by the state. And money that didn't lead to those drawbacks that we are discussing now. And this decoupling of money from state power is a very strong political statement. In fact, it's one of the strongest political statements that anyone has made about money in the last hundreds, potentially thousands of years. And this is why crypto is important. This is the cyberpunk ethos. It is the radical idea that we can have money from the people, for the people, by the people, decoupled by states. And DeFi is an extension on this idea. It is the idea that we can also have financial services that are decoupled from intermediaries. Okay? If you were around in 2008, there was a whole lot of discussion around banks operating in an extractive manner on the economy and the need for ushering something new. This is the realization of that something new. Or at least this was the original intent of decentralized cryptocurrencies from where DeFi picked up. Okay? I hope that makes sense.
So we have some great participation. We have 42 out of the 51 attendees having.
Wow.
Yeah, that's some
That's
great
great.
participation. Thank you, everyone.
Can you give me some idea of what the polls are saying because I cannot see them?
I can end the poll and actually show the questions, the results to everyone. But I figured because now it's up to 85%, we could wait like 30
Okay.
more, 30 more
So
seconds because I think they're trying to complete, everyone's trying to complete it, I think.
sure. Let me define it again. So DeFi is a collection of decentralized, open source, peer-to-peer financial services built on blockchain technology with the goal of minimizing reliance on third parties like banks, and with the goal of achieving transparency and inclusive, affordable, universal finance. Okay, so this is what DeFi is. These are the characteristics of DeFi. It draws on the characteristics. So DeFi relies on open decentralized blockchains and it adopts their attributes. So it's open, permissionless, and censorship resistant. It facilitates peer-to-peer transactions, decentralized validation. It is public and transparent, immutability, and borderlessness. Okay. So, Andreas, what are
Okay,
the polls
get
saying?
ready for some interesting results first of all. And we have amazing participation of 92%. So,
Thanks, guys.
yeah,
Thanks, folks. Thanks, everyone.
look at this
Okay, so
first
have
one.
you ever used a decentralized exchange? Amazingly, this answer is split 50-50. 50% of you have used it, 50% of you have not used decentralized exchanges. Which of the following DeFi services have you used before? Top one is none of the above. So there's lots of people, again, 50% have not used DeFi, but the top one is swaps on decentralized exchanges, lending and borrowing platforms, and then we have perpetuals and futures. Very well done to those advanced of you to be uh, uh, getting your hands dirty with perpetuals and futures. And how often do you utilize DeFi tools? Again, we have half of the people who have never used DeFi. Many use DeFi every single week. I am impressed. I cannot claim to use DeFi every single week. Once during the past months and then once during the past years. Thank you very much for your participation. Again, DeFi is growing a lot. You can see here the total value locked, which you can think of as assets under management by DeFi protocols. You can see the DEX volume, and you can also see the volume of perpetuals. Okay, what are perpetuals now? Because I appreciate that not everyone has a finance background, and there are some questions on derivative contracts. So perpetuals, and especially those of you with no finance background, pay some attention to this. I'll try to make it simple. Perpetuals are a form of a financial derivative. A financial derivative, is a contract between two parties, me and you, whose value, as the name suggests, is derived from an underlying asset. So we have different kinds of derivatives. The easiest one to understand is what we call a futures derivative, a futures contract. So a futures contract, let's say we enter a futures contract, this is the lingo, we enter a futures contract, is an obligation to buy or sell an asset at a set price at a set date. So we agree that you will buy Bitcoin from me for $100,000 on December 31st, 2026. Okay, so this is what a future is. An options contract is similar to a future, but gives you the right and not the obligation to buy the asset. A swap, which is another popular kind of derivative, is an agreement to exchange cash flows. Well, just keep that in mind. You don't need to know what it is exactly. And there is also something called a forward, which is essentially a futures contract that is traded OTC, over the counter. What does over the counter mean? It means that it's not regulated. It is a contract that you and I can enter as two individuals without, going through some exchange. Okay? So, what are perpetuals and why are they so prevalent in crypto? Perpetuals are the most liquid instrument in crypto trading. This goes to show you how important they are. And unlike futures, per, which, as we have established, settle on a certain date, perpetuals never settle. They can be held indefinitely. And what happens is if the price trades above spot, above our target, shorts pay longs and vice versa. So if you're betting with your perpetual that the price is going to go up and the price does indeed go up, you get paid by the one who bets that the price will go down. Look, derivatives are one of the most complex parts of finance, not decentralized finance, finance, period. So I hope you use this as a starting point and look into them a little bit more. Okay? Why are they so popular? They are margin products. They're used for leverage. Okay, they're used for levering your position. Okay. DeFi stack. What's the DeFi stack? It's the building blocks that make up DeFi. Each layer, now we're not talking about layer ones and layer twos, we're talking about the components of DeFi. Each layer builds on the one below it. So we have the settlement layer, which is the foundation. It's the blockchain where all transactions are settled and where the native token resides. And so native token, i.e. Ether or Solana, and there is a multiple choice question on that. So watch out. We have the asset layer, which includes everything of value that lives on top of a blockchain. That includes the various token standards that we will see in a bit. We have the protocol layer, which is one of the most important layers because it is the smart contracts that power DeFi activities like the ones we'll be discussed, like swaps, lending, borrowing, and so on. Then we have the application layer, which is how you and I interact with decentralized protocols. You and I don't talk directly to a smart contract. We don't write code, right? We go on a website or we use our mobile phone and initiate transactions from there, okay? This Web2 interface is what we call the application layer. And finally, we have the aggregation layer. Now, what is the aggregation layer? It is a step above the application layer. So it is another application that combines applications together. So for instance, if I go, let's take Ledger as an example. If I open up Ledger's hardware wallet app on my computer and I want to swap two tokens, it will look up different quotes from different decentralized exchanges and aggregate them. So this is the aggregation layer. I hope that's clear. Okay, so this is, again, settlement layer, asset layer, protocol layer, application layer, and aggregation layer. So lending and borrowing. Decentralized lending and borrowing does what a bank does, but through smart contracts and without a bank. The way it works is that you deposit crypto as collateral, and in return, you can borrow money against it. The protocol manages everything. It manages interest rates, liquidations, it manages repayments, everything. And importantly, you need no credit checks or KYC. So here's a comparison table. Importantly, you will notice that creditors and debtors can be anyone, including agents, non-humans, right? Another important distinction is that TradFi lending can be under-collateralized, okay? So what does this mean? In TradFi, banks can lend you more than you put up as collateral, because they have other protections. They can check your credit history, they can run KYC, they can take you to court if you don't repay, they can force you to repay. In other words, they can assess how likely you are to pay back, and if you don't, they have ways to force you to pay back. And this allows them to sometimes offer under collateralized or even unsecured lending. For instance, I'm sure you've all seen like those that you can apply for very small loans, consumer loans, 20, 30, 40, 50,000 pounds in the UK, basically by doing nothing if you have a decent credit history. I mean, I get those emails all the time. Oh, I mean, you are approved for this and that consumer loan, buy a car, and so on and so forth. Obviously, those are, for the most part, unsecured. Okay. DeFi doesn't have a KYC. There are no credit checks. There is no legal recourse. There is no identity. There is no nothing. The smart contract cannot chase you down. So the only option DeFi lending has is the only recourse DeFi protocols have is the collateral you lock up. And because crypto is volatile, that collateral needs to be worth more than what you borrow, okay, to ensure you have enough in case prices fall, okay? And I want to take a moment here and say, so for instance, let me see if I can draw something here. If you supply, let's see, let's say this is $150 worth of ETH, you can borrow up to $100 worth of USDC. Okay, so there is a buffer here, okay, which ensures that even if the price of ETH, which is volatile, falls a little bit, right, it falls to 120 here, there's still your position is not unsecured, right? There is still enough collateral to back your loan, okay? And what would happen in this instance, the moment the value of ETH hits 150 and drops below, your collateral would be sold off at current market prices to make sure that your position is covered, okay? So why do this very capital inefficient thing, right? Why supply liquidity if you, why borrow if you already have the money, and why borrow less than what you can support? Two things: so that you don't lose exposure, and for leverage. Okay, here's what that means. Suppose you expect ETH prices to go up, but you need to take care of a few things. You need to pay a few bills. You need to pay rent. Okay, but you don't want to sell your ETH because you expect prices are going to go up. What you can do is you can lock up your ETH, borrow USDC against it, swap that USDC for dollars, pay your rent, okay? And then once you make that money back, you can repay your loan and retrieve your ETH collateral. In the meantime, if the price of ETH did in fact went up, you have benefited from that. You didn't lose exposure to ETH, right? So it is done when you don't want to lose exposure, okay? Andreas, I don't know if I'm, and everyone, I don't know if I'm doing a good job of explaining it. I hope everyone is following. Put a thumbs up in the chat if you understood what I've said up until now. Okay, we have people responding positively. Second reason is leverage. So here's a cool thing you can do. And in fact, there are some apps that do it automatically for you. You lock up your ETH in a smart contract, borrow, this is very important, so pay attention. You lock up your ETH, you borrow stable coins against it, you use that stable coin to buy more ETH, you lock up even more ETH, use that to borrow even more stable coins, swap that for ETH, and repeat. Doing that, you have increased your exposure to ETH. You have folded your position. You've used a margin of 150 initial ETH and multiplied your exposure to Ether. Because if you take this 150, take this 100 USDC, swap it for $100 dollars worth of ETH, resupply that, then you have $250 worth of ETH suddenly. This nested borrowing that people are mentioning in the chat. I call it position folding. So those are the two primary reasons for lending and borrowing in DeFi. Also, there are flash loans and so on and so forth. Some popular borrowing platforms, and then we get into DEXs. A DEX is a smart contract that lets you swap tokens online with other users. Or to be more precise, you don't swap tokens with other users. There's a question on that later on. You swap with tokens that other users have deposited in the contract, right? And this is all done with no broker, no custodian, and no intermediary. Okay, so DEXs do not work with order books. What is an order book? An order book is how a centralized exchange maintains buyers and sellers. So the way it is done on centralized exchanges is that we collect all the buy and sell orders for an asset. And the price, the market price is determined by where those buy and the bids and asks meet. And we also have entities called market makers that keep the markets liquid by constantly posting bids and asks. Okay, so I hope this is clear from that. This is a representation of an order book. Okay, so why can't DEXs use order books? Well, every order book. So let's see in the chat. Why do you think DEXs, decentralized exchanges, would not work under an order book model? Put it in the chat. The answer is fees. Every order on a blockchain costs gas fees. You post an order, you pay a fee, you cancel it, you pay a fee again. It would simply be too expensive to operate an order book on chain, and that would result in very low liquidity. Okay, so we came up with a concept called liquidity pools. So essentially, instead of matching buyers and sellers, we have a shared pot of funds that are locked in a smart contract. Anyone can deposit into it and become a market maker, essentially. And we call market makers liquidity providers in DeFi. When you want to trade, you supply one token and you receive another token, okay? And the exchange rate is set algorithmically by the protocol, okay? So this is what an AMM is. The most popular such algorithm is the constant product formula. So the way this works is that, let's say, for instance, you supply 2 ETH and you supply 5,000 USDC, that would give you 10,000 K. K is a constant, right? If I want to buy 0.5 ETH from this pool, right? What I would need to do we need to solve for to find how much USDC I will have to supply is do that. 1.5 times we don't know how much equals the constant value of 10K. And if you solve for that, you will find out that the answer is 666. So you need to supply essentially, how much is that? 1,666 USDC. Okay? So effectively, you raise the price of ETH by 1,666 USDC. Okay? So I think that's pretty much it. Again, you should have studied this yourselves. I'm just going over, I'm skimming through the material now and pointing out things I deem important. And now we'll get to your questions, which Andreas will very kindly share with you. Before I get to your questions, I hope everything was clear. Use the Q&A to ask any follow-ups, okay? We have some questions from Gabriella. Gabriella asks, how does DeFi remove intermediaries while still maintaining trust? That's a great question. DeFi applications, essentially, as we said, are in essence decentralized applications. And decentralized applications rely on smart contracts. This means that DeFi's functionality is encoded as a set of predetermined rules in a smart contracts. Smart contracts execute programmatically and deterministically. This means that for any given input, we can be certain what the output is going to be. And those contracts are programmed to perform certain actions, such as swap tokens or facilitate lending and borrowing. Another important component for trust is that most of the time, the logic behind those contracts is transparent and verifiable on chain. So essentially, the role of the intermediary, the role of the bank, the role of the trusted entity is taken over by trust in the immutability of code and the deterministic execution of smart contracts. Okay, so I hope this answers your question. Another question, how do DeFi protocols manage risk without centralized oversight? Again, I think I addressed this in my previous answer. Essentially, code is law, right? There is no financial risk because financial risk is not baked into the coding of decentralized finance applications. There is only a risk of bugs. Okay, so what is a bug? I intend the contract to do A, and it ends up it does B. So those are mitigated through standard processes in computer science, reviews, bug fixes, and so on, bounties, and so on. And the only risk you are assuming is not related to DeFi, but it is related to your own choices. So for instance, if you fold your position, if you lever yourself to an extreme amount and prices in the markets fall, it is not the smart contract's fault that you lost money, right? It is poor judgment on your end, right? So in that sense, the financial risk does not come from the protocol, right? And the protocol is not hurt. It comes from yourself, and you're the only one hurt, right? What are the main building blocks of the DeFi ecosystem? Again, I addressed this very thoroughly, I think. It is the DeFi stack, the settlement layer, the asset layer, the protocol layer, the application layer, the aggregation layer. What role do liquidity pools play in decentralized exchanges? A pool is essentially a smart contract holding assets, as I said. Okay, so and you trade. You don't trade against users. You trade against pools. indexes and lending and borrowing. What are the biggest security risks in DeFi protocols? We had a very nice discussion. I don't know if you remember, Andreas, with Charles last week. Do you remember what he said? His biggest, what he thinks is the biggest risk when it comes to wallets.
I think it was either extensions and the hacks that could happen with, a hacker messing with your screen. And then I think that's the biggest takeaway I had. Was
Yeah.
there was there something like,
Didn't we say about didn't we discuss about social engineering? The
yeah,
idea
yes,
that someone
phishing,
can
yes.
finesse you into giving up information. Uh, I think the biggest risk when it comes to DeFi is that someone will finesse you into believing some BS. Right? I cannot tell you how many times I have friends call me or bring because they know I'm into crypto, right? So they it always starts the same way. Oh, it's not me, but a friend of mine or a cousin heard about this amazing scheme where you deposit this amount of money and within that many weeks you make 40 or 50%. It's not me. I'm very skeptical of those things, but it's a friend, it's a family member, it's a distant cousin. And and I asked them, did they mention how this works? And they always say, oh, it's this DeFi and stablecoin stuff. Okay. The biggest risk is that you're going to be finessed in some non-legitimate venture by some grifter. So keep an eye out, I guess.
Yeah,
If
phishing
you,
was number one. Sorry for interrupting. Phishing was number one, and
yeah,
there were actually many instances of phishing like that were very public, such as, do you remember these schemes where they would tell you to deposit, for example, Ether, and they would return double, like, and they
yeah,
and, and they chose some big names to hack and to
Elon Musk
Elon
is here,
Vitalik maybe.
doubling your ETH or your they're gonna pay you back in some shit coin. Look, here's my view. Okay, I might be biased. I'm teaching at the university. Um, if you are to invest somewhere to start, invest in education. This is my motto, right? If you're keen to invest somewhere, invest in your education, right? And investing in education will save you from so many pitfalls and caveats, and you're gonna have a great time doing that. I'm just yeah, that's all I can say. I'm wrapping up my PhD on crypto, right? I've had a blast learning about this space. Every day is a new experience. So if you are to invest somewhere, invest in education first. Where was I? Um,
Next one is, how do smart contract vulnerabilities impact DeFi platforms?
Same way bugs affect other things, right? You can lose your money. You can lose part of your money. Your money can be locked up for a long time, right? So there's nothing new under the sun. What is impermanent loss and why does it occur? So this is involved. So pay very close attention, please. Impermanent loss is the loss you incur as a liquidity provider, as a market maker, when the price of your deposited tokens changes relative to the price of when you deposited them. So we are talking about the loss that happens that might happen between when you deposit a pair of Ether and USDC to Uniswap and when you withdraw it from Uniswap. You retrieve your liquidity. So here's how that happens. When the price of one token against another arises in a centralized exchange or in the open market, say the price of ETH rises relative to USDC, decentralized exchange prices are not updated automatically. Okay, there is no oracle to determine prices. They rely on arbitrage. So what will happen is that arbitrageurs are going to buy cheap ETH from DEXs and sell it on SEXs, centralized exchanges, until the pool's price matches the SEX market price. So they take the appreciating token out and leave you with the cheaper one. Obviously, the more they do it, the more the cheaper token you will receive, but still you earn less money as a liquidity provider compared to if you just held the token. Okay. So it's called impermanent loss because if prices return to where they were when you deposited, the loss disappears. And in practice, you earn fees and protocol rewards which largely offset impermanent loss. Okay. Who controls DeFi protocols once they are deployed? In principle, no one. Once a smart contract is deployed, it runs autonomously. In practice, we have many DeFi protocols that are governed by DAOs, and many DAOs where holders have privileged access to those smart contracts that allow them to pause the protocol, update it, or change some parameters. So in principle, no one. In practice, many smart contracts are centralized. How do you know which ones are centralized? Do your own research, but the big ones are, relatively speaking, good citizens. Like Uniswap is a good citizen, for instance. I can feel confident, saying that. Again, not investment advice, but it's definitely not the DEX that your cousin recommended you trade on. How can regulators supervise financial activity occurring in DeFi? That's a huge discussion, which I'm going to leave for the regulatory session with,
Jeff.
Jeff. Oh my God. Yeah, Jeff Panban. Are DeFi protocols subject to AML, KYC obligations? We have a few questions on that. I'll spend some more time later on. But the thing is, if your protocol is truly decentralized, then no. So if the FATC cannot identify an individual, which they can throw in jail or charge with a crime, the answer is that your AML and KYC obligations do not apply. Who is legally responsible if a DeFi protocol fails? No one. We have a question from Abubakar. How can one find a trusted peer-to-peer trader on a DEX? Look, as I said, DEXs in the past had tried working under an order book model. And the way, obviously with no KYC, no identities, although there were attempts at also incorporating identities. For the most part, you'd use an escrow service, right? But again, those exchanges were the liquidity was very thin. It was very hard to match prices, and we have moved on to AMMs, automated market makers. One of the benefits of AMMs is that you don't have to trust individual traders. Instead, you trade against a pool, right? And you don't have to trust people who put their money in the pool. You just have to trust the code and of Uniswap, let's say, or PancakeSwap. And the good thing about trusting code is that you can code is deterministic and you can verify it yourself or have someone run an audit of it or rely on some good audit of this code. So the answer is, Abubakar, thankfully, thank God, you don't have to find a trusted P2P trader on DEXs. Stephen, I would like to know how DeFi could be utilized in future marketplaces. Is that futures markets? So is that the derivative markets or future marketplaces? If it's in the futures market, then perpetuals are an innovation that we talked about. If it's in future marketplaces, again, I will discuss this a little bit later on, but my thesis is that the line between finance, what we call TradFi, what we call DeFi, what we call fintech, will blur to the point that, in a few years' time, there will be no material distinction between them. Okay? So, I'm not sure if that answers your question, but in other words, in the future, there's not going to be DeFi. There's just going to be finance. Unless we hit some artificial superintelligence and the concept of money itself disappears and we enter some post scarcity paradise. A man can only dream. Cool. Gatis, I think I pronounced that correctly, asks, venture capital firms and the world's largest financial institutions. I don't know if you want to zoom in, Andreas. I think I'm getting old. So Gaddis says venture capital firms and the world's largest financial institutions are most probably the primary controls of liquidity pool assets and act as the main market makers. I'm not sure that is the case, but let's assume it is for the sake of for the sake of the question. What does this mean for the future of DeFi? Can it truly evolve as an alternative to traditional financial system? Is it going to be integrated and become just another instrument? Look, at the University of Nicosia, we've been saying for a long time that the line between decentralized finance, as I said, traditional finance is becoming increasingly thin. Okay. There is some movement from traditional finance to embrace crypto innovations. Some crypto innovations have been forced onto traditional finance. So stable coins and tokenizations stand out. Consider that stable coin providers, okay, are one of the world's largest holders of US debt, one of the world's largest holders of treasury bills, at a time where historical US allies are thinking twice about their exposure to US credit, right? So stablecoins are becoming integral to the American financial empire. Now, I'm not saying it's not a value judgment. It is a matter of fact, right? So tokenization is another thing. Like this idea of a radical restructuring of the financial system where everything settles atop a blockchain. Okay, I'm not sure that tokenization will pan out the way most people think it will pan out. But the idea, the takeaway, the key takeaway here is that there is some movement from TradFi into crypto, and there is quite a lot of move happening from the side of DeFi to be moving into traditional finance. Okay, the two will converge. Okay, and we are now in the in-between period. Here is my bet. Here's why I still think decentralization matters. It matters because it gives you a choice. If you have a censorship resistant, credibly neutral, transparent, robust, principled blockchain, you can do both. You can swing both ways. You can build a decentralized application on top of it, and you can also build a very centralized application on top of it. Okay? If you have some shitty database run by corrupt bankers, evil monopoly guys with the monocle and cigars. You can only build corpus slop, centralized BS, and things that are not good for the world. Okay? You cannot build a credibly neutral, decentralized application on top of that. So my bet is not that in a few years' time, we're going to be living in a decentralized utopia, right? My bet is that blockchains will give us a choice, okay, to deploy the applications and the tools that are right for the job, and there are jobs where centralized tools are perfectly suited for, and jobs for which the centralized tools are not perfectly suited for. Okay, so this is my thesis on that. Very good discussion on Tether in the chat. Gold also. Yeah. So Tether is also buying gold. Eduardo asks, I would like to know if hardware wallets or cold wallets will be able to use DeFi protocols in the future. They already can. So you just connect them. There are many ways to do so. You can even do through their native apps. Why is it possible to access real world assets on Rabbi and impossible on Trezor? Look, one of the things of building in open source, decentralized, the censorship resistant, blah blah blah, all the modifiers, technologies is that, well, you don't have to wait for Trezor to officially support some asset and list it on their Web2 interface. You just plug the token address in Trezor and it shows up, right? And you can do that with all wallets, by the way. Okay, so Rabbi does not acknowledge or all tokens. What you can do is hit on import asset, paste the token address, and there you have it. It now supports it. Again, going back to my previous point about why it is important to build on robust technologies, right? Imagine if you had to call up Ledger or Rabbi and ask them to formally list some low liquidity, thinly traded token, something you came up as a joke or for a community to trade with, and so on and so forth. Diego asks, I noticed ERC223 was designed specifically to prevent money losses that happen with ERC20. Why is it not the go-to? So for those of you who don't know, ERC223 notifies essentially the receiving contract when before tokens arrive, and it allows the receiving contract to either accept or reject the transfer. Okay, and this addresses the issue we have with ERC token, which ERC20, which is the go-to token standard in the market, where you just send your funds to the wrong address and they're lost forever. Excuse me. So ERC20 is the go-to still due to network effects and high switching costs. Essentially, you'd have to convince the entire DeFi ecosystem to redo everything to support ERC223. So the honest answer is that better doesn't always win in standard wars. Okay, what wins is again what people are used to. I was fascinated by ERC 993, the idea of delegated NFTs for land registration. Again, God knows how many of those things are going to become widely adopted. My bet is very few. How can a censorship-resistant public blockchain actually maintain legal validity with a physical governance registry without becoming a permission centralized system that defeats the whole purpose of DeFi? Again, I've said it thrice, I've said it another time. you can build centralized systems or centralized systems on or systems that have centralized components on decentralized blockchains. You cannot do the opposite. So the honest reality is that you cannot have both. If you want legal validity, you would require a state to recognize a token as a proof of ownership, which means that the state has to be involved, which means that the state would have to intervene to override, assign, invalidate tokens. So this beats the censorship resistant aspect of DeFi, but it does so in this particular use case, in that token standard. You have the rest of the space operating like we're used to in a decentralized manner, okay? So again, in that particular use case, you would have a more centralized arrangement. In the comparison between DeFi and TradFi lending, forced liquidation is listed as a major risk. For the borrower, if there is no human intermediary to talk to and the smart contract executes automatically. How is a user supposed to protect themselves during extreme market volatility when their collateral value drops instantly? So what happens is when your collateral drops below a certain threshold, your collateral is not liquidated by humans, it's liquidated by bots, right? So it happens very fast. What can you do to protect yourself? Supply and excess of collateral. Like if we are in a volatile period, okay, supply 1.5, 2, 3, 4, 5, 10, 15 times the collateral you need. This cushions you, this shields you against extreme price movements. Secondly, have a bot of your own to unwind your position in case, in other words, liquidate your own position. You can do that, as a matter of fact. And finally, do not supply liquidity if you do not borrow money if the market is going crazy. Do something less risky. We have a question from Obafemi, and I'm going to be checking I'm keeping an eye on the chat. I see we have just a few questions in the Q&A, but I just want to make sure that there isn't anything that I'm missing. Again, so people are asking where on earth to post questions. I'm going to show you now, so I'm going to take a break. I'm going to show you now. So this is our learning management software. Can you see my screen now? I think you can. Okay.
Lambis, I think I need to stop sharing now.
No, I think they can see both.
Oh, really?
There's a window showing up.
Okay,
So again,
please tell us in the chat. Yeah.
you have a very similar view to that. So what you're gonna do, what you wanna do is scroll down to the respective session you wanna post questions for. So let's say this week, click on that. Under live Q&A, you will notice that there is a post your questions for session 5 here. If you click on that, you'll see that students are posting questions. Now, I'm not going to show that now because I'm not sure if people want their full names, but you get the point. And this will be the case for week 6, 7, 8, 9, and so on and so forth, right? So I hope this clarifies that. Cool. Okay, let me pick up from where I left. Obafemi asks, given that many AMM-based DEXs rely heavily on arbitrage with centralized order books, would you say price discovery in crypto markets still primarily occurs on centralized exchanges like Binance, Coinbase, and Kraken, with DeFi acting more as a secondary liquidity layer? I don't have the numbers, but I would assume that most of the activity happens on CEXs. To answer your question, absolutely. Right? DEXs have no oracles. Arbitrage is how their prices are adjusted. But also arbitrage goes both ways. So there might be a price discrepancy in a centralized exchange that is arbitraged away from a decentralized exchange. But yeah, for the most part, um, I price correction in dexes happens based on market prices that are found in sexes for the most part. Another question: as trading activity becomes more fragmented across sexes and on-chain venues, how do centralized exchanges like Binance, Coinbase, Kraken approach detecting potential market manipulation that may originate from DeFi protocols, but ultimately impact price formation centralized exchanges? Look, sexes run your standard market surveillance tools, particularly for their own books. They look for layering. They particularly, especially if they're regulated, look for wash trading, and they monitor their books very closely. Okay, there's nothing forcing them to monitor the market, and I cannot think of an instance where something happened in a decentralized exchange that somehow harmed centralized exchanges. It is a very interesting question, though. If you have something in mind, a potential exploit that might involve, or a potential market manipulation maneuver that would involve a decentralized exchange and potentially harm a centralized exchange, do let me know. What sexes are concerned about is things such as obviously receiving transactions that are associated with addresses that have been involved in terrorism, prostitution, not prostitution, but trafficking is the word I'm looking for, drugs, sanctions, or other illegal activities. There is a list of sanctioned addresses, and most regulated exchanges, so I think all regulated exchanges should abide by that. From an institutional perspective, what are the biggest operational or regulatory barriers preventing large trading firms from directly providing liquidity to decentralized finance protocols while still maintaining compliance standards? Again, perhaps this is a better question for Jeff Bandman. Here's my attempt at answering this. On the regulatory side, the core problem is that interacting with a permissionless smart contract doesn't fit into any compliance network framework I know of. The key thing here is like KYC and AML obligations, which large trading firms should abide by. So those regulations require that you know your counterparty. And in DeFi, there is no counterparty, right? A trading firm providing liquidity on Uniswap is transacting with an anonymous wallet that just hits a pool. This wallet might be involved in terrorism, potentially might be involved in trafficking, it might be involved in all sorts of things. More likely not, though. But because there is the sliver of chance that it might be involved in, most compliance teams of trading firms would never sign off on such liquidity provision. Okay, so the FATF rule, which says that beneficiary information that you need to transmit beneficiary information alongside transfers, is my understanding of it is, and you can ask Jeff, that it is essentially incompatible with how AMMs work, right? So it's a huge challenge. And there are other challenges too, like it is largely unclear whether governance tokens that are given out by DEXs are securities. It is unclear, to my knowledge, whether yield from liquidity provision is interest income or something else. Obviously, there is smart contract risk. There is key management issues. I think you'd be very hard pressed to find institutional participation in such decentralized platforms unless things change very radically. What do you see as the biggest systemic risk in decentralized finance today? Stablecoins. It is the elephant in the room, right? DeFi, decentralized finance, is almost entirely reliant on a small set of extremely centralized, some people would even say less than ideal when it comes to transparency entities that control large stablecoins. And this is not only a liability for DeFi, it is also a liability for the United States, funny enough, because lots of their debt is held by those entities. And it is not only a liability of the United States, it is also a liability for the traditional banking sector, because those entities, see the discussion with the Genius Act, are starting to compete with banks. All things point to Trump allowing stablecoin providers and cryptocurrency exchanges to pay interest on stablecoins, which would draw deposits away. If deposits are taken away from banks, your funding rates go up, and liquidity becomes more expensive. Stablecoins are a huge systemic risk, or a huge potential systemic risk. So we need to look into stablecoins much closer. Shout out to our, not next week, but the week after that, we have a session with Laura. What's her last name? Laura from Ripple. She's the product management of RLUSD, which is Ripple's stablecoin. So please have some very tough questions for Laura. She's going to be presenting what they do at Ripple, and she's going to be answering your questions. I'm going to have some very tough questions for her, but I urge you to help me out and post some very tough questions in the forum. Cool. Peter asks, Peter, with your great questions on AML, are fiat on-ramps, off-ramps effective? Again, Peter, I saw some of your excellent questions in the previous session. Do make sure to follow our session with Jeff Bandman, right? He's your man. He's the best person to answer your questions. I'll do an impression of an answer. I'll try my best. Are fiat on-off ramps effectively the primary interface between TradFi, CeFi, and DeFi ecosystems? Yes. From an AML perspective, do these gateways represent the main control points for detecting all those vile things we've been discussing? Yes. And how does this affect financial crime investigations when illicit activity occurs deeper within DeFi protocols? Look, historically, I'm gonna answer this with an anecdote. Historically, and this is less now the case than it used to, historically, you've needed an off-ramp to do anything with your crypto profits. Okay, we all know Silk Road, and to to give you a sense of how strictly those on and off ramps are regulated, okay? The inventor, the creator of Silk Road, was a billionaire on paper, right? He was a Bitcoin billionaire. He couldn't withdraw his profits. He couldn't withdraw Bitcoin because they would, even back in the day, they would have known who he is, right? So when he was arrested in an apartment which he couldn't make rent for, he had trouble feeding himself. That's how broke he was. And he was a billionaire on paper. So I'd say that for the most part, regulating those on-ramps and off-ramps is enough-ish. Secondly, if your decentralized finance protocol is not decentralized, as the name suggests, and regulators can point to a specific entity or collection of entities that have privileged access, then regulations apply to them. Okay? You cannot use DeFi to operate in a regulatory gray area as a centralized entity, right? So that is important to understand. Finally, we are increasingly seeing a list of sanctioned addresses, okay? Traditional finance actors and regulators are becoming increasingly sophisticated in this space. We have advanced techniques for de-anonymization and tracing of activities, okay? So that is to say that if you are someone who does something particularly vile using crypto in 2026, your days are very limited. In fact, I would argue you're better off doing your vile business in traditional finance. And I think that does provide a very nice mix of, if you're a small fish, nobody's going to extend the resources to chase you down or to, trace the history of your transactions. Nobody cares what Andreas or Katarina or Labis do on chain, right? We do nothing. The amount of money we play with and the things we do, are of no material concern to anyone. If you're doing very vile stuff, though, governments and organizations can put in the work and find out who you are. Politicization of money. The lecture referenced politicization of money, which I've caveated, Peter. From an AML perspective, are there parallels between traditional correspondent banking controls such as the travel rule and regulatory expectations placed on crypto off-ramps? I think I've covered that. Okay, so the FATF's, FATF's travel rule, it requires transmitting information along with transfers, is largely incompatible with Texas, but again, there are regulatory expectations placed on entities from an AML perspective, especially at the off-ramps. Peer-to-peer and cross-border crypto-enabled money laundering. Given peer-to-peer and borderless nature of DeFi transactions, does this significantly expand the potential for cross-border crypto-enabled money laundering? It does not. I mean, maybe in theory, but every empirical study, like I'm talking about proper empirical studies, right, points to the following. The amount of illicit activities that happen on chain is vanishingly small. Okay. I think it all started with this paper, which has a very fancy name, which I'm going to put in the chat for everyone. It is by a certain gentleman called Sean Foley. Sean Foley is an academic who is in Australia at the moment. And this was published back in 2019. the Review of Financial Studies, which is a very good ABS for journal in finance, and it gathered lots of attention. This is the paper. It's called Sex, Drugs, and Bitcoin: How Much Illegal Activity is Financed Through Cryptocurrencies. Peter, if you're interested in finding out more about this, have a look at this. But please do keep in mind that this was back in the day. And there have been follow-up studies. So use this as a basis for your research, but there have been lots of follow-up studies that escape me at the moment that pin the amount of illicit activity to, near effectively zero and much less than what's happening in traditional finance. So sex, drugs, and Bitcoin. ERC 998, again, we discussed about that. Are there any conceptual parallels with layered complex ownership structures seen in traditional finance? How do we square this with financial transparency? I think the closest parallel is like a shell compact layering scheme. I'm not an expert, but that's what I would point to. However, unlike traditional finance and unlike shell company layering in some haven jurisdiction, blockchains are in principle fully auditable. Okay, so eventually, given enough money and resources and time, every ownership relationship is visible on chain. Okay, thanks, Peter. So it's good to see that we agree. And you have to keep in mind that there is lots of sophisticated tooling under development, right? We can de-anonymize Chainalysis, for instance, which is a crypto auditing firm, can de-anonymize Monero and Zcash transactions that utilize ring signatures that were thought to be unbreakable. Now, is it easy to do? I don't think it is, but they can do. DEX and regulation. Are decentralized exchanges used as pathways for entering or exiting DeFi ecosystems, and are regulators considering ways to bring these platforms within AML frameworks? What do you think this would apply for the regulatory scope of virtual asset service providers? Again, as I've said many times in this life, there is it all depends on if you're genuinely decentralized. So here's what I know. The FATF has some updated guidance that takes the position that if a DeFi protocol has a controlling party, which we can identify, okay, so a founder, some DAO that is centralized, then they are compliant. They're subject to compliance. Okay. I'm being conscious of time. As users increasingly interact with aggregation layer rather than individual protocols, where does the liability reside? Users are interacting with the application layer for the most part and the aggregation layer. So the liability is with the user, and it is again with the protocol in case there is a founder, a development company, a DAO with broken governance that can be identified and can be sued. A few questions from Zhong. From decentralized lending, it's subject to platform risk? Yes, it is. So let me read the question again. I'm not sure I understand the question exactly, but platform risk is not the same as centralization risk, right? Platform risk could be a badly coded smart contract. Okay. There's also centralization risk. So I deploy some shitty DEX I have the backdoor. I have a backdoor in that shitty DEX. It's not audited. You use that DEX, you lose your money. This is both an example of platform risk and of centralization risk. Okay. In today's practice and North America in general, approximately how much is the current market share for decentralized lending? I mean, I'm going to show you a resource. I wouldn't know how to answer that. DeFi Llama. Let's see. So this is a good sort of dashboard. Let's see if we can look it up. So this has leverage lending, which you can get some data on. Can you just do lending? I'm sure you can, but I'm a little bit pressed by time at the moment. So again, you should be able to find some information on this website. So I'm gonna leave this as an exercise to you. I don't know what the exact market share is between DeFi lending and traditional lending, but I think those are numbers that you can figure out. Stablecoins. Again, I'm not being lazy, I'm just pressed for time. Stablecoins, with governments issuing stablecoins, seems like most of these are issued off-chain. They're not issued off-chain, they're issued on-chain. We have an off-chain stablecoin, it's called the US dollar. Question from Juan. Stablecoins, again, those are outside the scope of today's discussion, but I'm going to skim over them. Is it very positive? It is very positive that the usage of stablecoins, USDC, USDT, is growing. I read this as a statement and not as a question. So I'll leave this for our discussion with Lauren. And John, are Tether, USDC, and other stablecoins really DeFi since they can they have custody of the underlying asset? In my opinion, they're not. But that's the good thing about DeFi and about decentralization. You can have both legitimate decentralized stuff built on top of that and more centralized deployments. And there is no law that determines what is centralized or decentralized. Decentralization is a spectrum. And I think there is merit to the concept of stablecoins, even if they are centralized. Now, should they be the primary interface of DEX? Some people do say so. Some people make money saying so. If you ask for my personal opinion, well, I would favor a decentralized stablecoin for many reasons, of many of which I hopefully have convinced you today of. Let me get into some of the questions in the Q&A. Andreas, have you had a look at them?
I was actually focusing on the questions I was.
Okay, thanks.
Yeah.
Can you give some examples of native, I think Carmen means native new applications type of services inherent to the technology, DeFi, blockchain, not available in DeFi, TradFi. Look into flash loans, which are a new way of uncollateralized loan. Flash loans are made possible because of the atomic nature of blockchain transactions, which means that transactions either happen in their entirely as described, or do not happen at all. Again, there is an entire course in the MSc in blockchain digital currency on DeFi, so we're just scratching the surface here. So look into flash loans and look into perpetual contracts. Andreas,
I would also point Carmen.
what's the correct answer?
No, there's no correct answer. And I would also point Carmen to the fact that you can look at, applications which are application level, as we talked about, but also look at all the mechanisms that we discussed about, that they're not, apart, that they do not appear in centralized finance, like AMMs, liquidity pools, and there. I think Lambic, correct me if I'm wrong. And all these features that we discussed, they can be seen as money Legos because you can use one protocol, utilize it, and then, for example, take a loan, then use that token that you take into another protocol, etc., etc.
Yeah,
And the way that the DeFi protocols connect with each other is something that you can't do on centralized finance.
true. Yeah. And another innovative component is obviously the fact that you don't need KYC to take out the loan. Try that with a bank. Like, here's a challenge for you. Like, put on a biker's helmet or a balaclava and walk into a bank and ask for money. See what they do. No, actually, don't do that. but you get my point, Carmen. Thank you for the great question. Again, look into perpetual contracts, especially if you're more in the finance realm, and look into flash loans. And if you're an MSc student, do look into the DeFi course that the university offers. We have a question from Niger. Assuming that DeFi protocols are shown to be composable and interdependent, could the composability of these protocols lead to systemic risks similar to those which were prevalent in the derivatives market prior to the 2008 financial crisis? That's such an amazing statement, right? And something that I haven't thought of before. So, in other words, Niger is asking, does this benefit or what we advertise as a benefit in DeFi, the interconnectedness between one protocol and the other protocol, and so on and so forth, be a weakness in effect? And I would argue that Nizer is right and has a very fresh reading on that matter. Uh, yeah, I think you're right. I mean, if you read into what happened with UST, Terra Luna, and with the whole ecosystem of applications that relied on the stable coin, okay, then what you're describing is exactly that, a propagation of risk through the interconnectedness. So that was a very thank you for this observation. Another comment from Niger. DeFi aims to reduce or eliminate centralized intermediaries, but a large number of them still rely on governance tokens, and a large number of DeFi relies on governance tokens. Less so now than what it used to. I think we've come to the realization that DeFi governance or governance in general didn't work out the way we wanted it to, or the way we thought it would. The key question is whether this creates a new form of financial centralization. It absolutely does. And how governance structures can help to counter this problem. Look into, again, I'm pressed for time, so look into the thought leading posts that Vitalik Buterin has been putting out as of late, including on governance. Andreas.
Yeah, I was just gonna say real quick that this observation also can be understood from your questions because we got so many questions on stablecoins.
Yeah.
And I'm pretty positive that in previous iterations we didn't have as many questions on stablecoins in the DeFi session. And that shows that the institutionalization is catching up. We had maybe some questions on governance, some more technical questions,
Yeah.
but not so many on, for example, Tether and other stablecoins.
Yeah, I think people are coming to the realization that uh, the killer app of crypto, for or one of the killer apps of crypto is stablecoins, which is totally ironic because it is stablecoins are a very centralized business. Question by Cornelius. Yeah, decentralized finance is designed to remove intermediaries, but many protocols still rely on developers, governance tokens, and large stakeholders. To what extent is DeFi truly decentralized? We just answered this question. How do you think about concentration of certain assets by individuals or large corporations? Take, for example, Mike Saylor sweeping up DeFi. I think it's a stupid idea what Michael Saylor is doing. But that's just lambis. That's not financial advice. That's not anything. I think, look, the basic principle of finance is diversification. You don't want to put your eggs in one basket. It's very bad practice to do so. I think it's a stupid idea, but I understand why he does it. I don't think it's going to work out, but that's my personal opinion. Cool. Let's see if there is anything else going on. No more questions. Thanks, Peter. I think we are right on time, which is even more impressive for a group of Greeks. Uh, we started on time and ended on time. So yeah, again, these sessions are always so much fun to do. They're also exhausting because there is a lot of ground to cover. And again, we are jumping from one question to the other, and they deal with different aspects and components of the space. And we have to consider so many things when answering them, but it is always a blast. So I was hosting last week's session as a moderator. I'm gonna be making a guest appearance, I guess, in next week's session on prediction markets with Apostolos. It's a new session we're doing this year, and there is another session on stablecoins, which I'm going to be which I'm going to be discussing with Lauren, and then I'm just going to go back to grading papers and working on research. So thank you for hanging out with me. What we will try to do for our MSc students is have some hangout session towards the end of the course. I think that would be amazing to gather some feedback on how it went. I'd love to, like, put a face to the name for so many of you. Thanks for your amazing questions. Thank you, Andrea, for facilitating this, and thank you everyone for joining me. Have a great rest of your day, night,
And thank you,
and
Katerina, as
stay
well.
safe until next week. Yeah, thanks everyone. Bye.